Yo, what is going on, stock market investors? My name is Jason and welcome back to the channel. In today's episode, I want to talk to you about Sofi and a huge concern I have about the company. Most of you who follow my channel already know that I am a huge Sofi bull. I currently own right around 4,000 shares, but that doesn't mean everything with the company is perfect or everything is going great, right? On this channel, I want to give you guys the truth, the good, the bad, and the ugly. And this particular situation is a little ugly. It's a little dicey, so make sure you stick around for the video. And if you haven't yet, hit that like button and subscribe to the channel to get all my Sofi and stock market updates. Let's get into it. All right, Sofi investors. So what major concern am I actually talking about? I did a video on the debt crisis a few weeks ago. I'll leave a link in the description if you want to check that video out later. Currently, household debt is over $17 trillion, right? So in my head, I'm like, how could this possibly affect Sofi? In my opinion, there's like a hierarchy of likelihood of loan defaults, right? First is going to be credit cards. That's going to be the first type of loan that people default on. And then next is student loans and personal loans. They're about the same in my opinion. Then it goes car loans and then mortgages, right? So where is Sofi exposed to loans? If you look at their portfolio, most of their loans, actually a majority of their loans, are personal loans. And I'm going to explain to you why this is not a good thing. All right, Sofi fam, if you take a look at the screen right here, this is a breakdown of all the loans on Sofi's books. You can see where the red arrow is, it's about $15 billion in personal loans. And we only have around $22 billion in total loans. Home loans make up pretty much nothing in this portfolio and right around $7 billion in student loans. So if you take the personal loans and you divide it by the total amount of loans, we're right around 70% of the total loans are made up of personal loans, and right around 20-ish% is going to be the student loans, right? But the personal loans, in my opinion, are even more risky than the student loans. So what does this actually mean? So if the economy that is currently $17 trillion in debt starts to go in the shitter, we could see some serious defaults happening with personal loans. A key metric we want to keep our eyes on as Sofi investors is the unemployment rate. If we get to around 5% or higher than 5%, there could be a lot of defaults on these personal loans. Luckily for Sofi investors, most of the loans that Sofi gives out is to people with credit scores over 750. So the likelihood of these people defaulting on their loans is a little bit less than the everyday Joe that has a credit score around the 650 range. Another reason why this concerns me and could spell potential trouble for Sofi is if you look at the chart on the screen, this is the percent of balances that are 90 or more days delinquent by loan type. If you look towards the right of this chart, we can see a huge jump in credit card delinquencies over 90 days and a slight increase in auto loans as well. The reason we see this huge decrease in student loan delinquencies is because they don't have to report these delinquencies until Q4 of this year. But we're seeing a sharp uptrend in credit card debt, so this could spell trouble for the economy because people want to pay their mortgage and their auto loans, but they're starting to become delinquent with their credit card payments. I do think student loans and home loans will increase over time, especially because Sofi acquired Wyndham Capital, the mortgage company. So I want to see in the next earnings report to see this number go up significantly. And I want to see student loans in that $7-8 billion range. In my opinion, I want to see these numbers go up and personal loans go up a little bit, but I want to see the increase in student and home loans go up significantly more than personal loans, so we can start to balance out this portfolio a little bit. We don't ever want to be too concentrated in one particular loan segment. Next, I want to give you guys some context of this loan percentage, right? So I want to break down some of the biggest banks in the country and see how concentrated they are in personal loans. In my research, guys, this was the most comprehensive chart I could find. The article was originally from 2018, but was updated in 2021. So these numbers today might be a little bit different, but you can get the idea of where these big banks kind of work with consumer loans compared to their other loans, right? So we're going to break down Wells Fargo, Bank of America, JP Morgan Chase, Citigroup, and US Bancorp. Commercial loans, mortgages, credit card loans, commercial real estate loans, and consumer loans. And if you take a look at this chart, I'm just going to go over the average, right? These top 5 banks, 39% are commercial loans, 28% are residential mortgages, 12% credit card loans, 11% commercial real estate loans, and consumer or personal loans is only 10% of their portfolio. SoFi's portfolio currently is at 68.5%, right? So you guys can see why I'm so concerned about the heavy concentration for SoFi in personal loans and why it's so important for them to build on student loans and mortgages and really expand on their credit card and commercial loans eventually, right? So as SoFi kind of gets bigger and works their way up into the top 50 banks in America, we want to see them start to diversify this portfolio. Because if you look across the concentration, the biggest bank in consumer loans is US Bancorp at 15%. SoFi is currently sitting around 70%. So we obviously want to see that number get under 50% and work our way down towards 25% and then 15%, in my opinion, right? But other banks are exposed to a lot of commercial loans too, which is not great because commercial real estate is getting absolutely slaughtered. So Bank of America and Citigroup are heavily exposed to those commercial loans. So every one of these banks has an area where they're exposed to more risk. Bank of America and Citigroup are commercial loans. And if you look across this, Wells Fargo is in residential mortgages. So each and every bank picks a segment where they want to be a little more risky in. SoFi, in particular, is personal loans. But none of these numbers cross over 50%. So we need to get that number under 50%, in my opinion, over the next, 12, 24, 36 months. We just want to see progress being made, right? But it's not all terrible, right? And I'm going to show you why. Now that I'm done scaring the living dog shit out of all my fellow SoFi investors, I'm going to show you the grass is greener on the other side. All right, lending products is up 20% year over year. And financial service products are up 42% year over year. So financial services are growing exponentially more than the lending products. So I'm going to show you why that's a good thing, right? So this is the guidance that they just gave out last quarter. It says there's going to be a 50-50 revenue split between lending and the combined tech platform and financial services. So what we're starting to see is the tech platform and financial services are soon going to surpass the amount of revenue that the loan segments are doing. So that's a good thing. We're starting to diversify this portfolio more and more and more, and that's going to benefit SoFi investors in the long term and kind of de-risk us a little bit, right? Tech platform net revenue growth of 20% versus 2023 levels. The lending adjustment net revenue is 92 to 95% of 2023 levels. So that's coming down a little bit with this kind of macro environment that we're living in right now, which I think is a smart decision because these defaults could potentially happen. So we don't want to overextend ourselves, right? I think Noto and the team are doing what they're supposed to be doing. So that's why I'm not super insanely concerned about this concentration in personal loans. I do think mortgages and student loans and the credit card segments are going to grow exponentially more than the loan platform for SoFi. So that's why I think moving forward, we're going to start to see this concentration be less and less and less of the total revenue for SoFi. I know when you see that concentration that I laid out for you guys, it can be very, very concerning. And you just need to be aware what's happening. So if the economy goes in the shitter, we can kind of adjust our portfolios accordingly, right? We can kind of de-risk and de-leverage ourselves if we're overweight in SoFi. Because in the short term, they could get hit pretty hard. But long term, I don't think this is going to affect SoFi, but in the next year or two, if the economy goes terribly, we could see an even lower stock price moving forward. If you're okay with that risk, great. If you're not, you could sell out of your shares, potentially sell some puts or buy back in later once macroeconomically and interest rates start to go down. It could be a better climate for SoFi investors. I know there was some good and some bad that I laid out for you guys, but I just want to be here for you guys to give you the truth because that's what I'm here to do. I'm not here to sell you any courses or do any bullshit. All you need to do for me is just subscribe to the channel, hit that like button. That's all I need from you guys. I just want you to be prepared for what could potentially be ahead just so you're aware of it. I'm not saying that defaults are definitely going to happen, but we should be aware of how SoFi's portfolio is set up just in case the economy does kind of start to decline and we see unemployment tick up. We can be prepared for the storm that could potentially be ahead. All right, I really appreciate you guys tuning into this video. If you like these kind of videos, leave me some comments in the section down below. I appreciate you guys. Don't forget to like and subscribe. Peace.